As of Wednesday, January 28, 2026, at 11:20 a.m. Eastern Time, Intel stock is trading at 48.36 USD, representing a sharp intraday increase of 4.43 USD, or roughly 10.08% today. This sudden surge in Intel stock marks a significant reversal from the massive selling pressure we saw just a few days ago following their latest financial disclosure. While the broader indices are showing some tech strength, the outperformance here is driven by specific catalysts that have caught the market off guard. Specifically, the news hitting the wires regarding a potential collaboration with NVIDIA stock for their 2028 silicon strategy has acted as a massive tailwind. This development is exactly the kind of reality check that challenges the prevailing narrative of a company in permanent decline. For months, the consensus was that the manufacturing turnaround was too expensive and too slow, but seeing a primary competitor like NVIDIA potentially looking at Intel for foundry services changes the math entirely for anyone holding an individual brokerage account. The tension between expectation and reality with Intel Corp has never been tighter. Most investors expected a quiet recovery, assuming the 18A process node would be a slow burn with years of trial and error. However, the reality of the current price action reveals that the institutional appetite for Western-based semiconductor manufacturing is much higher than the retail crowd realized. When we look at the trading volume today, we are seeing a heavy influx of capital, likely from major players like Fidelity or those managing large-scale Fidelity wealth management portfolios. These aren't just retail traders on a Robinhood app looking for a quick scalp. This is systematic accumulation. Even though the company issued soft guidance for the upcoming quarter, the underlying strength in the data center and AI segment, known as DCAI, is proving to be more resilient than the bears argued. The narrative that they were losing the data center war is being tested by the actual revenue numbers, which grew 9% year over year in the fourth quarter of 2025. If you look at the recent daily swings, Intel has been a roller coaster for those involved in online investing. Just last week, the stock plummeted nearly 20% after management warned about supply constraints for the first quarter of 2026. Many saw this as proof of operational failure. But then an interesting thing happened. On Monday, January 26th, the chief financial officer, David Zinsner, bought $250,000 worth of shares personally at an average price of $42.50. When a top executive puts their own capital on the line after a stock crash, it sends a clear signal to the market that the internal view of the company's health is much better than the external panic suggests. This insider activity, combined with today's rumors of a deeper partnership with NVIDIA stock, has forced short sellers to cover their positions rapidly. This is why we are seeing such a violent move toward the $50 level today. Those using a SoFi active investing account or interactive brokers trading tools are likely seeing the volatility metrics spike as the stock tries to find a new equilibrium. The institutional activity over the past month shows a clear divide. Large entities like BlackRock and Vanguard have been maintaining massive positions, even as the stock price fluctuated between the low 30s and mid-50s. The recent volatility has allowed for a significant amount of weak hand shakeouts, leaving the shares in the hands of those with a longer time horizon. For anyone using Schwab Intelligent Portfolios or similar automated investment help, these fluctuations often get smoothed out, but for the active trader, the 18A yield reports are the real North Star. Currently, yields for the 18A process are rumored to be sitting between 55 and 75%. To be truly profitable and competitive with the likes of TSMC, they need to push those numbers above 80% by the end of the year. The fact that the stock is rallying despite these known challenges suggests that the market is beginning to price in a successful execution of the IDM 2.0 strategy. To understand why this move matters, we have to look at the business model. Intel operates as an integrated device manufacturer, which means they both design and manufacture their own chips. This has been their greatest strength and their biggest burden. Lately, they have separated the reporting for Intel products and Intel Foundry. This was a smart move because it allows the market to value the product side, which is still highly profitable in the client computing group, separately from the Foundry side, which is currently burning cash to build out infrastructure. The 18A node is the centerpiece of this entire plan. It introduces ribbon FET and PowerVia technologies, which are essentially new ways to build and power transistors. If these work as intended, Intel could regain the lead in power efficiency and performance density. This is what the long-term bulls are betting on when they look at investing sites for the next big semiconductor play. While we are on the subject of holdings and market sentiment, I want to hear from you directly. Comment below how many shares of Intel stock you currently hold, or if you are waiting for a deeper pullback before you commit more capital to this semiconductor turnaround. It is always helpful to see how the community is positioned during these massive intraday moves. Looking back at the older reports, 2025 was a year of stabilization. Revenue for the full year 2025 came in at $52.9 billion, which was essentially flat compared to 2024. While flat growth doesn't usually excite the market, for a company undergoing a total overhaul of its manufacturing plants, it was seen as a victory. They managed to cut costs significantly, reducing R&D and MG&A expenses by 17%. This lean operating model is what allowed them to beat earnings expectations last week, even if the revenue guidance for the next quarter was lackluster. The market is now looking past the short-term supply issues, which are largely due to substrate shortages and bottlenecks in advanced packaging, and focusing on the massive demand for AI-capable hardware. The launch of the Panther Lake chips, also known as the Core Ultra Series 3, is the big catalyst for 2026. These are the first consumer chips built on the 18A process and are expected to power over 200 new laptop designs this year. The macroeconomic pressures cannot be ignored either. We are in a period where sovereign supply chains are becoming a matter of national security. The U.S. government is heavily backing Intel through the CHIPS Act, providing billions in subsidies and loans to ensure that the most advanced chips are made on American soil. This gives Intel a moat that other semiconductor companies don't have. If you are doing online investing through a Fidelity brokerage account or a Robinhood investments account, you have to factor in this government support. It acts as a safety net that effectively prevents the company from failing even if they hit further technical snags. This political tailwind is a major reason why the stock hasn't collapsed back to the levels we saw years ago, despite the intense competition from AMD and Apple stock, which have moved toward their own custom silicon. The expectation versus reality framing for Intel is simple. The expectation is that they will continue to struggle as a second-tier foundry. The reality is that they are securing massive customers like Microsoft and potentially NVIDIA for future nodes. If Intel can prove that their 18A process is viable for high-volume manufacturing, the valuation of the foundry business alone could justify a much higher stock price. Right now, the market is valuing the entire company at a price-to-sales ratio of about 4.3. This is significantly lower than the industry average of 5.9 and the peer average of 13.8. This valuation gap exists because of the uncertainty around their manufacturing success. But as each technical milestone is met, like the successful power-on of Panther Lake, that gap begins to close. When we shift our focus to the future outlook, several scenarios emerge. The most bullish scenario involves the 18A process reaching high yields by the third quarter of 2026, leading to a massive influx of external foundry customers. This would transform Intel from a struggling chip maker into the Western world's premier manufacturing hub for all high-performance computing. The bearish scenario is that the supply constraints mentioned in the last earnings call persist longer than expected, causing them to lose further market share in the client computing space to Qualcomm or AMD. However, the current momentum suggests that the worst of the operational friction might be behind them. The high-stakes nature of the 18A launch makes 2026 a make-or-break year. If you are looking at investment help or self-investing through a platform like Interactive Brokers, keeping a close eye on the quarterly gross margin figures will be essential. They are currently expecting a contraction to around 34.5% in the short term due to the high startup costs of new factories, but any improvement there will be a massive catalyst for the stock. As we wrap up this analysis, the central insight is that Intel is no longer just a legacy processor company. It is a high-conviction bet on the future of American manufacturing. The contrast between the soft Q1 2026 guidance and today's 10% rally shows that the market is willing to forgive short-term operational hiccups in favor of the larger strategic wins. The insider buying from the CFO at 42.50 served as a floor, and the NVIDIA rumors have provided the ceiling breakout. We have seen a shift from a narrative of survival to a narrative of competition. Whether you are using a Fidelity mobile app to track your 401k or a Robinhood stock trading account for active plays, the importance of Intel in the global semiconductor ecosystem is undeniable. The stock